A lot of crypto founders still think the taxman can't see their wallet. As of this year, that is no longer true. And the mistakes that used to be invisible are about to get very expensive. Let's go through the ones that cost the most. First, a disclaimer. This video is for informational purposes only and does not constitute legal advice. Consult our team or another qualified professional for personalized guidance. Hey everyone, Robert here, legal consultant, licensed tax advisor, and registered trademark and design representative. At Chiroptera Consulting, crypto and tax are two of our core pillars, so this one sits right in our wheelhouse. Today, the crypto tax mistakes that quietly cost EU founders thousands. And number one is so common, it's basically the whole problem. Mistake one. Thinking there's such a thing as the EU crypto tax. There isn't. The EU does not have one crypto tax. Income and capital gains tax is decided country by country, and the rules are wildly different. In one country, hold your crypto long enough and your gains can be tax-free. In the next country over, every single time you cash out, a big slice goes to the state. So when a founder reads country X is crypto tax-free and assumes it applies to them, that's the most expensive assumption in crypto. Your tax bill depends entirely on where you're a tax resident. There's no shortcut around that. Mistake two. And this is the big shift this year. Assuming nobody's watching. That era just ended. As of January 2026, an EU rule called DAC-8 makes crypto exchanges collect and report their users' transactions to the tax authorities, who then automatically share it with each other across the EU. And it doesn't matter if your exchange sits outside the EU, what matters is that you're an EU tax resident. Here's the timing to know. Your 2026 transactions are the first ones captured, and they reach the tax authorities in 2027. So the return you file for this year is the one they can check against. The old "they'll never know" plan is dead. Not declaring isn't hiding anymore, it's a detectable offense. Mistake 3. Believing you only owe tax when you turn crypto into actual cash or fiat. In a lot of EU countries, that's flat wrong. Swapping one token for another, say Bitcoin for Ether, can itself be a taxable event, even though you never touched a euro. In other countries, that same swap is tax-free. See the pattern? It depends on where you are, and guessing wrong means you either owe tax you didn't budget for, or you miss filings you didn't know existed. Don't assume, check your member state. Mistake 4. The surprise income. Staking rewards, mining, airdrops, DeFi yield. In many countries, that's taxed as income the moment it lands in your wallet, valued at that day's price. Then when you sell it later, you can be taxed again on any gain. Founders treat these as free coins and forget them entirely, until the bill arrives for income they never cashed out and barely noticed. Track every reward the day you got it and what it was worth. Mistake 5. And this is where the real money is won or lost. The wrong structure. Running a serious crypto operation through your personal wallet or with no structure at all sets up two ugly surprises. One, you pay far more tax than you would through the right vehicle, and two, if you're trading actively or building a business, the taxman can decide your personal investing is actually business income and tax it that way. The flip side is the opportunity. With the right company in the right jurisdiction set up before you scale, you can be fully compliant and pay dramatically less. That's not a loophole, that's just structuring. and it's exactly what we do. And a bonus trap, because founders love this one, I'll just move to a crypto-friendly country and pay nothing. Sometimes that works beautifully. Done wrong, it's a disaster. You stay tax resident where you started, or you trigger an exit tax on the way out, or you move the day after the big sale instead of the day before. Relocation can be a real strategy, but the timing and the residency rules decide everything. Get advice before you pack, not after. Quick bit of good news, because it's not all bad. One thing actually is the same across the EU. Simply buying and selling crypto for regular money is exempt from VAT. An EU court settled that years ago, so at least that tax you can stop worrying about. Lightning recap. There is no single EU crypto tax, it's national, and it varies wildly, so never copy another country's rule. As of 2026, your exchange reports, EU and tax offices share the data. So invisible is over. In many countries, crypto-to-crypto trades and staking rewards are taxable even before you cash out. The biggest savings come from the right structure in the right place. Set up early. And moving countries only works if the timing and residency are handled right. Want to know exactly what you owe, where, and how to legally pay less before the tax office comes asking with your full transaction history in hand? Structuring your crypto the smart way is exactly what we do. Book a call with us. A link is in the description below. And if this saved you from a nasty surprise, smash that like button, send it to a fellow founder, and subscribe for more straight talk crypto and tax. Thanks for watching, and remember, compliance with the law prevents the flaw. Till next time.